Good morning. Today, I will be talking about carbon emissions and economics, the fundamentals. My name is Doug McMaster, and I am Vice President of Product at ComboCurve, a software company for reserves forecasting and emissions. Okay, so today, we're going to pretend that we're an operator in upstream oil and gas. And we've been getting a lot of pressure from our investors, from our community. We need to reduce our emissions. So what is your goal? What should be my goal? And that's probably a good place to start. Do I want to be the cleanest operator, or do I just want to be below average? So today, for the rest of the presentation, I'm going to take you through what it would be like, some of the analysis to get you from point A to point B. So, there's lots of different ways to get there, lots of different steps on that path. And that would support a strategy or different strategies to reduce emissions. So, but before we get there, we have to establish a baseline. How much am I emitting now? And that would be a model. Okay, so to do this evaluation properly, you're going to need a lot of data. And it's the classic data that if you're a reservoir engineer or petroleum engineer that everyone knows and loves. It's all the ingredients to understand the current state and development plan of your company. So you need your well data, your equipment, your ownership and working interest. You need a forecast, decline curves, type curves that take into account completion, spacing, geology, and also some more decline curve analysis. Additionally, you'll need some scheduling. And of course, today we'll talk about the new component involved in this major workflow, emissions. So equipment, measurements, model inputs, production accounting, and of course, all the ingredients to build your economics. But before we get into that detail, let's just start with the basics. Where do emissions come from? They come from many places. According to the framework from the subpart W of the EPA, there are different emission sources. You have venting directly to atmosphere, you have oil tanks, you have centrifugal compressors, pneumatic pumps, liquid unloading, pneumatic devices, flare and combustion. These are just a small subset of the different types of equipment and sources that emissions can originate from, that you're going to have to gather that data and understand. Okay, so this is abstract, it's just cartoon pictures on the slide. Let's dive in to some detail to demystify this and add some more imagery. So here's a detailed example of a reciprocating compressor, and specifically leaks. What actually is emitting to atmosphere that needs to be tracked and taken into account so that you know what's happening and what you can do to reduce it. So this is information directly from the EPA. And my primary intention here is to show you to show an exact example of a piece of equipment and exactly where on that piece of equipment, in this case, methane or natural gas gets emitted or leaks from different places on that equipment. So in this case, it's common to have 4 areas, leaks for reciprocating compressors: around the packing case, between the packing cups, and so that would be like a metal to metal seal that isn't perfect. There's also between the rings and the shaft. So leakage can be reduced by monitoring and then setting up in this case, a cost-effective schedule for replacing packing rings and pistons. And so a cost in this case would be the labor and the materials to go and fix this leak. Okay, so now we have one real example. You can see in this image on the right that somewhere between these gaps, there's a potential source of emissions. Okay, but that's qualitative. I've seen the equipment, I know it comes out, but how do I know what's happening when I'm not present or if I don't have measurement? Well, you model it. And that's exactly what the EPA does when they set forth a framework and a methodology to calculate the different types of emission sources. So right now, I'm going to walk you through how to quantify emissions from a pneumatic device. And so we'll start with everyone's favorite, emission factors. So this is, data inputs and assumptions that are available in the subpart W reference material on the websites. It's an excellent body of work. It takes very time consuming, it's very detailed, but if you're using that framework to estimate your emissions, you would have to go and read those tables. So in this case, we're going to estimate the emissions from 5 pneumatic devices that are the equipment type high continuous bleed. So therefore, they have a higher emission factor. And in this case, emission factor is in units of MCF per hour per device. So in this first calculation below, because remember, I'm trying to get to the fundamentals, what are all the way down to the basics. And in this case, we take that assumption, multiply it so that we can get up to from hours to the total volume in 1 month. And since we know that the industry runs on kind of monthly data when it comes to planning and reconciliation, it's a very common cadence. That's an important, it's important to understand 1 month so you can understand the entire time series. And so if we just multiply these together, we get at 138 MCF emissions. And in this case, the assumption here is this pneumatic device is being run on natural gas. I'm going to take one extra assumption that it's pure methane. So you take another equation, multiply those volumetric emissions, multiply it by density and some conversion factors, and you can convert it into mass emissions of methane in units of metric tons. And that unit metric tons is the de facto unit for understanding and normalizing, comparing apples to apples emissions in the industry. So you would take some gas composition, in this case 100% methane, multiply it by the density of methane at standard conditions, do some basic conversions, and you get to, for 1 month, 2.66 metric tons of mass emissions of methane. Great. So now I have methane. But how do I add it to all of the other emissions? And of carbon dioxide, nitrous oxide, the different greenhouse gases. Well, you normalize them, just like you would in comparing different assets for their total production, going from barrels and MCF to BOE, very similar in this space. You need to be able to normalize to compare apples to apples. So the primary input assumptions is the gross well potential, global warming potential, and that value. There are multiple choices, and they come from different agencies, and they all have different opinion on what it should be. And they primarily source from IPCC assessment reports. So you can see different assumptions, but really, what does it matter to this operator? Well, if your goal is to actually reduce, then you might model and choose a different global warming potential. So I have kind of this from left to right spectrum of what would be the right assumption if you wanted to act now. In other words, it would make the carbon dioxide equivalent value higher. So therefore, you would be more incentivized to reduce it if your goal was to cut it in half, for example. If you move over to the right, we also have what I call we have some time modeling. So I want to make the numbers of CO2e smaller in my voluntary disclosure, for example. So what to choose? Well, it just depends on your goals. And it depends on the project or your targets. What is the total asset life? Does it make sense to have a 100-year value versus a 25? So that really depends on your needs. But great, let's just calculate it so I can understand the exact calculations that are needed in this overall analysis. So you have mass emissions and carbon dioxide equivalents, and simply you just take the mass of methane, what we calculated on the previous slide, times the global warming potential, 25. In this case, I chose from this table in the middle on AR4 100 year, and you get 66.6 metric tons of carbon dioxide equivalent. Great. So we walked through some calculations for pneumatic devices. What did we actually do? If you've never done this before, you just calculated one component of of scope 1 emissions. But let's go more detail. It's scope 1 emissions in units of metric tons for carbon dioxide equivalent for 1 month, for one emission source, for one well. Okay, so that's pretty small in scope. What about the other scopes? Scope 1, scope 2, scope 3 of emissions. And what about instead of 1 month for the entire life of the well? That equipment, the pneumatic devices aren't just there doing nothing. They're only going to operate if they're serving production. And they don't just necessarily serve, they're not the only equipment on site, and they're not the only wells on site. So we need to go bigger. And to go bigger, you have to understand what are the different projects that are needed to reduce at a larger scale. So, first you start the small scale at the well level and the equipment level, and you say, how much is it emitting? How can I eliminate this? So in this case, you would retrofit a no bleed, the high bleed pneumatic device to a no bleed pneumatic device. And just like I said, you want to know total emissions for all your wells and equipment and emission sources. But you might ask yourself questions after you understand that baseline. What if I don't reduce it and I get taxed per some of the potentially upcoming legislation from the Inflation Reduction Act, which sets a fee or cost of $900 per metric ton of methane? Well, we just calculated that. And so now we have the input to be able to estimate how the cost impact for us. So, but most importantly, if you're this operator and you're trying to cut your emissions in half, what are your options and what is the bang for buck? And so to do that analysis, to understand the bang for buck for emissions reduction and the cost, is to go use conventional wisdom, use the framework and model project petroleum economics. Okay, again, fundamentals. What are economics comprised of? What are the individual units? Well, it's time series, and cash flows. So cash flows, monthly cash flows for the entire duration of the asset life. Well, that each time step, each month, each is made of a cash flow, and that cash flow has many components, or what is called the cash flow hierarchy. Well, carbon emissions and the inputs to this ensemble model is new. Well, relatively new. It's not something the industry or the reservoir engineers who are in charge of building the analysis to do investment decisions are used to taking into account. So where do these inputs go? Well, if we start to the bottom left, everyone should understand revenue, right? If you're in the business of producing oil, you want to sell it. So oil volume times price per volume gives you revenue. Well, what about emissions? Well, this is the spot where you would put earned carbon credits. This is also the spot where if you captured the vented methane, for example, and sent it to sales, then your total production would increase. Your total sales production would increase, and therefore your revenue will increase. Similarly, down here, you have your operating expenses, your operating costs. This is where potentially, depending on how the regulation passes, and depending how you do your accounting, if you purchase carbon credits to get a net reduction, you would put the cost of purchasing those credits here. Similarly, if you had a compressor on site that was running on diesel fuel, you might that is a variable amount of consumption, and that combustion value, the emission amount has to be calculated, and then you multiply the cost of that fuel usage in emission terms, just like we went through the example, to get your expenses. So down here on the bottom right, I do exactly that. We're going to continue our example. We have 2.66 metric tons of methane. And if I multiply for 1 month, multiplied by $900 per metric ton, which is in 2024 per the Inflation Reduction Act, you get about $2,400 a month. That's not small. So this is important to understand, where does it live in the overall cash flow hierarchy, so you can properly make an economic analysis to help inform a decision to support your emission reduction strategy. So then you also can have costs on the CapEx side, so your investment. So here would be intangible and tangible top costs. Great. So now we know where, down to the fundamentals, what part of the cash flow emissions will be impacting the economics. Okay, so what does that look like graphically for a time series? Well, let's say you're trying to budget a well, or you budget a well and you were reconciling that investment. So you have all of the classic components. You have the forecast. You have realized production. You have capital costs. So let's say drilling, completions, and some sort of emissions CapEx, like the additional equipment added on facilities compared to how you historically operated. Similarly, you have the variable or fixed emission expenses per that methane tax. Both of those combined will impact the cutoff of that well's economics, and therefore its net present value, return on investment, and all the classic investment metrics. So it's very important to understand your emissions profile, because if you didn't know it, your current development decisions are actually carbon decisions. Great. So now you know the cash flow, you know the different components, you know how to do it for one equipment, for one well. Well, if you add it all up and its impact to schedule and timing and your entire asset, now you want to model what are your big tranches of projects that you can really reduce at a high level your current emissions and how they all stack up to get to a net result. And so this should be familiar to you. Everyone in the industry likes to use a good waterfall chart. And so on the x-axis, you'd have different emissions reduction projects, and you would be reducing total emissions in carbon dioxide equivalent down from 150 to 70. This is about cutting in half. So you try to find enough projects to support if your goal of getting from this number and cutting it in half. Similarly, this same analysis should now be able to support what is that impact to your net present value. Well, some of these projects actually increase value, and especially for the case where you add a vapor recovery unit and you're sending what was vented to sales, make more money. But you also have situations where you have a carbon tax, and that is very important to understand. Similarly, this is just a different visualization on the same data, but how are some of these costs or changes dominated by CapEx, OpEx, or revenue? So just kind of characterizing the projects to reduce emissions. Okay, so I went through the investment analysis, but one thing I glossed over was, this emissions thing is pretty complex because how equipment is distributed in the field is complex. So there's really no other way than trying to model the emissions as a network that can be applied at the well, the facility, or asset level. So you can take into account like flare that is as a fraction of your total production that is sourced from your decline curve. So building these out and the relationships is very important to get an estimate of your emissions, but also projects to reduce. So now that we understand what the typical visualizations and analysis looks like for your typical investments, that would be net present value, those waterfall charts. What does that look like for emissions? Similar thing. You want to know the carbon dioxide equivalents at the well level or at the time series for the entire duration of life. So, and you want to compare those what if questions, the same what if questions you're asking yourself for the business to hit your budget targets, increase your returns, and satisfy your investors. And so let's do our emissions reporting the same way. Let's build it out like a reserves report. What are the total emissions for carbon dioxide, methane, nitrous oxide tied to the different categories of reserves? PDPs, PDNPs, total proof, that sort of thing. So emissions should impact your economics, and you should report it like that. All right, so let's talk about how using our software, ComboCurve, which takes into account this full workflow and in one unified platform, same button click that generates your economics also generates your emissions. And so we actually here have a case study where we modeled real reduction scenarios on a handful of wells, and we were able to model replacing pneumatic devices and troubled facilities with large flare rates, and we decreased that emissions intensity almost in half, from 9.8 to 5.6 kilograms of carbon dioxide equivalent per BOE. Similarly, so that's on the emissions front, but how does it impact the economics? Well, here are the three cases, and then the total, overall, the total expenses were reduced by $1.5 million. The revenue was increased about $800,000, And the total cost per pneumatic device was about 10,000. That was what it was modeled at, and 250,000 for to do the upgrades. So this resulted in an NPV increase of 934,000. So who knew that it was possible to have emissions projects actually increase the value of your assets? So it's very important to start modeling and understand that, so you can get from point A to point B of reducing your emissions and understanding which investments are the best bang for your buck. So that's all I have for today. And if you have any questions, please come find me. Thanks.